Good morning. Thank you for being here. We're going to give about 2 minutes for folks to join us. Grab your coffee. We'll be with you momentarily. Good morning. We'll be with you in about 25 seconds. We're just grabbing coffee, waiting for a few more to join us. Hello, welcome, and my name's Bill Bymel, and thank you for joining the Win-Win webinar series. I have an exciting audience in store today. If you are here with us live, please, click on the Q&A, submit questions. Anytime over the next hour, we'll get to them. But we have an exciting topic of a group of questions and some great participants that are joining us here today. I'll give these gentlemen an opportunity to introduce themselves in a moment. First, I have to calm down from the fact that my face is red from from having done that on mute. Anyways, for those of you that are watching this on a replay, the Win-Win webinar series we do quarterly. We look to have conversations about all things real estate, commercial real estate, residential real estate, housing finance, private equity investing. The lineup of gentlemen I have here today spans all of those sectors. And this is really meant to be a look into the fourth quarter of 2023 and beyond. And we have some brilliant minds here. For those of you that don't know me, my name is Bill Bymel. I manage a fund that invests in mortgages, primarily residential real estate mortgages. I've been in real estate over 20 years. It's my passion, and I'm just happy to be here. Let me introduce my first guest, and Rick Sharga, returning champion. Now, I don't have to tell you to come off mute. Rick is, I'd like to say, is the eternal optimist of the group here today. Rick, tell us a little bit about yourself.
Well, thanks, Bill. I'm not sure I'm going to shed a whole lot of sunshine and rainbows and lollipops into the conversation today myself, but I'm the founder and CEO of a company called CJ Patrick Company. It's a market intelligence firm helping companies in the real estate and mortgage industries. I've been in the real estate data business one way or the other for the last 25 years. Before that, I spent the first part of my career in technology. And I've been with companies like Realty Track and Adam Data and Carrington Mortgage Holdings and Auction.com over the past 25 years. So delighted to join you for this, and hope we can help the viewers and the listeners make some educated decisions as they move forward.
Fantastic. Thank you for being here, Rick. Matthew Grossman, thanks for being here.
Of course. Thank you, Bill. It's really a pleasure to join you and the group here today. I'm very much looking forward to our conversation. So I'm joining from Long Island, New York. And just a little bit on my backstory. I started in the business better part of a decade ago, really on the institutional side, started at Bear Stearns, was there when the world last imploded. So that was certainly an interesting and sobering experience. Spent about 5 years at Rothschild. And then it was really about six and a half years ago that I started my platform, JMG Capital Properties, intuitively focused on equity investment in real asset, predominantly multifamily, mixed use retail. And really in the last 2.5, 3 years that we've transitioned into what I would really deem to be opportunistic credit. So really coming through to this conversation from the investor side and look forward to exploring, different parts of it with the panel.
That's great. And you said you were at Bear Stearns, and you strike me as a young looking guy. You couldn't have been 10 years old working at Bear Stearns.
I was at a graduate school. So I graduated from college in 2005. For graduate school, was there for a couple of years, and my God, it happened very quickly. As we will discuss with banks, it can happen very quickly when it unwinds.
Yeah. It's all about timing.
So it certainly is.
We were talking about timing the other day, Matthew Mendel. Thank you for joining us. Tell us, your audience, a little bit about yourself.
Thanks, Bill. It's such a pleasure. I am the founder and CEO of Archstone Funds. We currently have about $400 million of assets under ownership. And I started in the real estate industry back in 1986 and have a background in M&A, investment banking, real estate. And we currently acquire distressed assets and NPLs on both the commercial and the resi side. And we do a lot of consulting for lending and financial institutions in the distress space.
Right. You can see I surround myself by guys that love going after sticky deals, right? And it's really great to have all of you gentlemen, because you are some of the what I have found to be the most brilliant minds that I've come across in this space. So let's start it out. Rick and Matthew Mendel were in the audience last week when I moderated a panel at the IMN conference in Dana Point. And the topic of that actual panel was exploring bank failures and opportunities in NPL as a result of it. And so, really as a follow-up to the conversation we were having there, there's only been officially 5 bank failures this year, but everyone seems to be waiting holding their breath, to say that this is on the horizon. There's obviously been some M&A, and we're getting topic after, comment after comment, both from the Fed and from Yellen and whatnot, about, the tightening regulations that are going to be put on small banks. Gentlemen, what are some key economic indicators that investors, should closely monitor to assess the health of, the commercial real estate market and the banking market? Who would like to take that from Matt? Who would like to take that one first?
I'd like to just make a comment that your audience might find interesting, is that if you look back at the 2008 failures, in the first year there was four failures of banks in the first year, followed by 400 over the next, I think it was 400, it was 200, I don't recall exactly, over the next 4 years. So it was just the tip of the iceberg. So far in 2023, the bank failures have, the volume of capital that was involved in the bank failures has exceeded that of the 2008 bank failures in the first year. So it's an indicator that's speaking to the potential failure of many more banks. And as you're probably aware, Moody's just downgraded the ratings of 10 large banks, including JP Morgan Chase and B of A. So they're expecting that there's going to be more bank failures as well.
Yeah, well, certainly. Any thoughts on that, Rick Sharga?
Well, about a month and a half ago, I saw a presentation from the chief economist at CBRE, a well-known brand in the commercial space. And he said they had reviewed all 4,700 or so banks across the country to look at their potential exposure. And we're estimating that about 300 of them were failure possibilities. Now, the overwhelming majority of those were smaller banks, community banks, small regionals that did have a fair amount of exposure in the commercial market. But a caveat here too is that I know we're talking about commercial today, but a lot of the challenges some of these banks are having has to do more with Fed policy than it does with commercial market failure. We have a lot of banks sitting on paper with interest rates considerably lower than what the Fed funds rate has turned out to be, and so the mark to market issue becomes a real problem if they have to liquidate, and that's really what happened at Silicon Valley and Signature Bank to a great extent. And the problem with that is once there's a rumor that a bank's in trouble, depositors start withdrawing en masse. And these days a run on the bank happens with one of these, and you don't have to wait outside and like it's a wonderful life, with the bank doors being locked. So there's a contagion danger that we have if a bank is rumored to be in trouble. But it's on the one hand, it's very real. On the other hand, if CBRE is right, it's not big enough that it really is a cause for concern in terms of the overall banking sector.
Rick, that's an excellent point. And I was going to say something along those lines as well. And just to add a little bit of flavor to that for the audience, if I may, one of the things that it becomes an issue, specifically speaking to your point, is that under GAAP accounting rules, the banks are allowed to allocate their assets based upon future value. They kind of arbitrarily get to pick a number. They basically look at the discounted net present value of the future cash flows based on their current portfolio, not on the actual realization, as you say, of what those assets would be worth in the event of them having to sell them off, which would mean them going to market. In other words, what's today's actual value, not what's the book value. And because they're allocating their P&Ls based on book value, not on actual value, if you were to look at the true value of what these banks, of their balance sheets, they would be 90% of them would be insolvent.
Wow.
Well, as long as it's just 90%, we're okay.
Only 90%.
But this, just to kind of put this in historical context, this is a similar situation to what we saw in the teeth of the Great Recession when it came to that huge wave of foreclosures that we saw. And back then, if a property went into foreclosure, about 75-80% of the time, it wound up going back to the lender as an REO asset. Similarly to what Matthew was just talking about, banks didn't have to write down the value of that home until they sold it. So we had this bizarre scenario where for a couple of years, banks were just hanging on to these vacant and abandoned properties so they wouldn't have to write down the value, because if a number of these banks had done that, they would have gone insolvent too, just because of the putative value of these homes compared to what they actually were worth. So this isn't the first time we've been through this. We've been to this dance.
That's very
one of the things banks are doing now is, in order to avoid having to reconcile their books, they're not putting a lot of their loans that are effectively in default into special servicing. They're not earmarking them as special service loans so that they can keep them on their books as good loans when they're really not, which then doesn't require them to have additional reserves in place, and it doesn't affect their ability to lend, which creates their cash flow. So
that's already happening in the commercial sector now, and which is I think why the big concern for banks, right? Because traditionally the largest investor in commercial loans, especially on in areas specific, regional banks and community banks, investing in their own communities, holding paper on office buildings. And so, Matthew Grossman, what are you hearing? You talk to banks all the time.
So I sort of come at this, a bit more optimistically. Just on this side of the equation, the Fed and the FDIC conducted their stress test. I think it was on like 23 or 25 major banks, back in June. Goldman, JPM, B of A, Citizens. That was pretty healthy. I think, Rick's point is well taken, that on the lower end of the totem pole, there's an exposure point there. And there really truly is a bifurcation between the too big to fail and sort of the lower end regional, community banks. I mean, the regionals are in a really tough spot, because of this mismatch between, longer term liquid assets and the base of short-term deposits to fund, that base of assets, and that sort of mismatch that exists on balance sheet. So there are certainly inherent challenges on the regionals, and I think that business model for the regional bank will evolve and will shift, and we'll have to conform in a new environment. And that's also where, to open it up to maybe a next level of discussion, but I sort of look to the private marketplace and private credit, and sort of where that interplay and co-disciplined sort of approach begins to take hold and take shape. And I think Dodd-Frank really sort of established that, and the importance and the prevalence of private credit and private debt. But there's really a codependency that very much, I think, will be at play between the smaller community regional banks and the private credit markets as we move forward.
Yeah, Matthew, to your point, and you brought up a very astute point, that the banking system is really a flawed business model on the regional banks, because they're using short-term deposits, right, that to fund long-term, there's short-term liabilities effectively funding long-term assets. And in the event that the I don't forget, was it Rick or Matthew mentioned, that in the event there's a run on the banks, they're not going to have the capital to be able to subsidize those. And to your point, Matthew, the private sector doesn't have that constraint, because they're borrowing money with the borrowers, with the people that are lending them money, understanding that it's a longer term investment. And so they don't have the maturity mismatch issues that cause the run on the banks, that cause failure. And so it's a much more stable and safe investment vehicle. And one of the things that's happening, though, is that the broadly syndicated loans, the BSL loans, which are loans that are greater than 100 million, there's been quite a bit of compression there, and there's been a lot of those. Those are basically loans that are 100 million plus. They're sold off in tranches to invest, to smaller banks and insurance companies, and which take kind of like a CMBS model. And there's been people that have been shying away from that and looking more at middle market. So larger deals aren't being done as much because of the fear of the higher interest rates and wanting to mitigate risk.
So that's very interesting. So do you think, that goes to, I keep believing in this top-down theory that some of the greatest meltdown is going to happen, amongst the high-end private equity and the super big deals, both in residential and commercial. And do you think do you think that that's a possibility? I mean, where do you guys see the most distress in terms of, and I guess the next topic to really go on to is how is the Fed, influencing all of this?
Well, if I could take a lead, from sort of a top down, if you look at it from a top down or a bottom up perspective, the way that I sort of look at, this downturn in this cycle is the pressure is almost intensively on equity, right? So if you looked at the great financial crisis, that was so systemic and was so institutional, just as a matter of comparative purposes, across capital structures. Here, I think it seems to be, from my perspective, in terms of where cost of capital has gone, where rates have gone, and how the Fed has aggressively moved over the last 18 months, the pressure is most prominently felt on the equity, right? So sort of how that plays through and how deals get recapitalized, where that liquidity and where is that sourced from and how is that played through will take different shapes and form. But it's really from the top of the capital stack where it's most acutely felt.
Mm. Mhm. I want to share this. Can we just talk briefly about CMBS delinquencies? Because Matthew Mendel sent over some data this morning, which was awesome. And this was a pretty up-to-date look at the CMBS and special servicing rate. And it has been on the rise for the last year and a half. There was a little bit of leveling off this summer, but it seems like it's still an upward trend. These MBS has always, to me, felt like a fragile market. I mean, somehow CMBS made it through, the GFC, and that was, I think, because of a decline in, obviously, commercial was directly helped by the declining interest rates of that market, and obviously QE. But where do we? Any thoughts on this and MBS? I just feel like there's so derivative products are. I believe, and Matthew, you guys probably know this. I've been told that the derivative products in today's market are even 10x or whatever in terms of volume comparative to where they were the last time we had some market shift. Who wants to take that one? That's a tough one. Any thoughts? I'm going to put Mandel. Can I put you on the spot?
Yeah, if you bring back up that infographic, I'll just put a little more explanation because sometimes it's hard to extrapolate the data.
Yes.
So what I have here is obviously the CMBS delinquency and special servicing rates. That's obvious. 2008 to 2023. The horizontal line is showing baseline today across time to see where we have an intersection of special servicing and to look at a trend analysis of the red arrows going up show that there's an increase in special servicing delinquencies, and the green arrow going down is a decrease. And it's just an interesting, you can start looking at the dates at the bottom and start seeing that it's a leading and lagging indicator that shows, okay, after the 2008 crash, then it took to 2009 for it really to start moving up dramatically, because it takes time for that to for them to start, people starting to default, and then the banks starting to work it out, and then as it starts to, the economy gets better, then in November 2014 it came back below baseline. And what was interesting for me when I looked at this was, okay, so we had COVID, right? It started going up right after COVID hit, and then the feds printed more money than is ever seen in the history of the United States, which saturated the market. Then all of a sudden, people used that capital to subsidize these loans, and delinquencies went down. And this goes to your earlier question that you touched on, Bill, which is kind of what's happening in both lending and the economy. And if you look at this graphic, it's telling because it shows that what's happened is that the Fed's printed a bunch of money. We had massive inflation. They raised rates, but during that, right now we're in the lagging indicator of a bunch of all the savings. 90% of the savings that were saved, the money that was saved during COVID has been spent, and now we're starting to see delinquency rise again because they burned through the reserves. So I anticipate that we're going to see a pretty substantial uptick in both defaults and in special servicing for multiple reasons, not only because interest rates are going up exponentially, which obviously requires people to have deeper pockets to be able to withstand those, but because they've also burned through the capital that they'd saved up, so they no longer have the reserves in place. So it's a little ugly.
Yeah,
that's a good technical term. I think you remember what Mark Twain said, that there are lies, damn lies, and statistics.
Yes.
And I think we're in danger of seeing these statistics tell us a story that maybe is a little off the mark. I think we're going to see delinquency rates rise because I think some people are going to take a look, do the math, and say, it doesn't make sense for me to be paying these rates anymore. There was a private equity firm that issued a press release announcing it was walking away from a $900 million mortgage on 2 hotels in San Francisco. When's the last time you saw somebody issue a press release to tell you they were going to stop paying their mortgage? But it was the company that took out a loan to buy the Park 55 hotel and the San Francisco Hilton, two very large, very venerable, well-known hotels in the region. And when they did the math, they realized that from their perspective, the hotels weren't worth nearly what they had paid for them, and it wasn't in their investors' interests to continue making those payments. So I think we're going to see, we talked a lot about strategic defaults back in the great financial crisis, and we really thought homeowners were smart enough to execute those. We're now dealing with people who do numbers for a living. And I would not be surprised to see a lot of people strategically default on loans for properties that they just don't think are worth what they paid for them anymore in order to get either get out from under the loan entirely or to get better terms. Just to put it in perspective, though, you were talking about the CMBS market. There's about a little over $1 trillion in outstanding CMBS right now. And most of it, about half of it, is actually in multifamily, which I've seen prices come down in the multifamily sector, but I think there's going to be so much demand for that, particularly as home prices have become unaffordable. Just demographically speaking, people tend to prefer to live indoors, and I think the multifamily market will be okay. But in the next 2 years, there are billions and billions of dollars of these CMBS notes coming due in multifamily and office. And the knee-jerk reaction is, boy, the office ones are in trouble. But I'm seeing a little bit of a shift in the data in that the suburban office market is actually doing relatively well right now. It's the central business district office sector within the major metros that are really, really getting hammered. And you look at San Francisco with vacancy rates up over 40%. LA hasn't reported something like that, but my wife and I were up there not too long ago, and it looked like a third world country downtown.
Downtown LA is 33% right now.
Wow.
So it's that, and that has a ripple effect even on other CRE segments. So what I'm curious about, maybe Matt knows the answer to this, is it would seem like the smallest banks, those with the least reserves, the least capital, are those not in central business districts in major metros, but in secondary and tertiary markets. But their CRE downturn may not be as severe as what we're seeing in some of the bigger areas.
To that question, I would say yes and no. There's a lot of factors and there's a lot of variables that sort of play in that. I mean, even when you're talking about certain, pockets of strength within suburban office, I think really what it is a flight to quality. And, that's what's really sort of playing through and cycling through, the office asset class. I mean, it's secular versus cyclical, right? I mean, the challenges in office are truly secular, and, BC class office today, there's an obsolete sort of nature to those assets. And there are regionals that have massive wide exposure to that. So I think it becomes like a balance sheet by balance sheet story, an asset by asset story. But there's inherent challenges and pressures that I think will be very broadly felt in that regard. The other thing that if I could just say one other quick point in regards to the chart that you put up, which I did think was interesting as well, was that in the most recent period, also take note of the gap between the special servicing rate and the delinquency rate, right?
Yes. Yeah.
We're very, very early in the cycle. And, banks, private debt funds, lenders are trying to figure out ways right now to extend and pretend and to buy time. And in certain asset classes, that will play, multifamily most prominently. But there's a long runway to go here.
Yeah,
What do you guys think?
Oh, go
I was
ahead.
going to ask, what do you think? What do you think is going to be the solution for the bank? What do you think they're going to do? Because they, like you, I mean, that's a great point, Matt. They've got to figure out what to do with these assets. Do they take them back? Do they extend it for 10? How do they refinance? Because obviously the DSCR isn't going to make it. The debt coverage ratio, vacancy rates are going to be too high. Expenses are out of control. The borrowers have given up on a lot of these and just they're walking away. It's strategically, right? So what do you guys think?
So much of it, look, the question really can begin to be asked at the borrower level, right? And then that sort of becomes the informative next step, for the lender. And there's so many variables within, credit quality, borrower strength, financial strength, and the entire toolkit of scenarios and, arrows that the lender has at their disposal. I think there's some combination of all of those that are going to be utilized here and that are going to be at play. From my side, on the investment side, there's going to be immense opportunity to buy. We look at it, through distress opportunities, and it's really, distress opportunities through, the sponsorship, that there's then a repricing at the asset level, which is appropriate, which is digestible to the counterparties and to the lenders. And, the market needs to begin to sort of process and saturate that. And I think we're in the early stages of beginning to see that take hold.
And I'm going to say this at the risk of making Bill right about me being the optimist in the group, but it does look, if you look at the RCA price indexes, it does look like pricing may have bottomed out and is starting to recover. If you look at all of their sectors combined, in the last month, prices are up about 0.3%. Over the last 3 months, are up about 0.1%. Now they're down almost 10% year over year, year to date. But if you look at virtually any of the segments outside of the central business district office segment, they appear to be stabilizing. So you could see over a period of time the prices start to come back, and if you can extend and pretend long enough, unless you happen to be in one of the markets where prices just plummeted, you might be able to hang on for a recovery.
I think that's a dead cat bounce, and that it's a blip, and that if you look at the financial indicators, cost per square foot, cap rate, the spread between the interest rates and the earnings, I think you're gonna see that it's the financial indicators that the current pricing is unsustainable, and that a lot of these people that invested were buying on speculation, thinking that effectively the greater fool theory. Someone dumber than me is going to come in, yeah, I know I'm overpaying for this, but it's okay because someone dumber than me is going to come in and buy me out, which was true for a certain period of time. But that's really a Ponzi scheme. That's not, those aren't sound fundamentals.
So you think we're going to see a double dip?
I think we're going to see a double dip just based. I don't think that the Feds are going to lower rates quickly enough to be able to gap the maturity mismatch that's going to happen as there's, what are you going to, like we touched on a minute ago, what do you do when these loans mature? You have to extend, but then now you're having to pay your borrowers 5% or more, and there's all of a sudden you may be negative arbitraging if these loans are if they won't cash flow past that same level, and it becomes very challenging. So I think that we're in for some rough times ahead, benefiting all of us being in the distressed markets, so we make money.
Right.
And if I could add just one other point to that quickly, Bill.
Yeah.
I think just the last and really critical variable that we can look at as to why I invariably, inevitably, I think prices will move down is the labor market, right? So that is the shoe that just has not dropped. And I think it's absolutely inevitable. So you can begin to extrapolate across, employment, office markets, rental growth or lack thereof across any variety in any number of different sectors. Like that is going to correlate with the labor market and the challenges that invariably are going to present itself. So I think, that's on the relative near term horizon. And that will be a real pressure point broadly across the industry.
Right. Yeah. And I agree with this. You gentlemen have touched on so many great points, so much great data. I'm going way back to what Matthew Mandel said about, the question I kept asking, we keep all asking is, well, when's the shoe going to drop? How is this keep going? For those of us who have been through cycles before, all of us in this room, it's like, what's going to be, we thought it would be COVID that would then the government, but the money printing thing was a real wild card factor. And Matthew Mandel pointed out that's a stat that's recently come out saying that 90% of those additional savings from PPP dollars and COVID and all of that has now been expended. And we are seeing credit card amounts, at all-time highs. Auto loan delinquencies, I believe, have just crossed a threshold worse than they were at the GFC with or just around that. If I'm correct, or no, I'm not right, Rick. He's going
highest level in a decade.
Oh, highest.
Right.
That's what it is.
Yeah.
Okay. Highest level in the decade. Okay, so
one of the reasons for that again is because of the EIDL and PPP loans. People went out and thought that they had free money and bought cars they couldn't afford, and now they're like giving them back, right?
Right. It's amazing.
Well, there's also a difference in consumer behavior this time. If you go back there, we saw people continue to make their auto loans and stop paying their mortgage. And we haven't seen that this time. Mortgage delinquency rates are actually historically low right now. And cynically, there's a thought that people realize they have a ton of equity in their homes this time and don't want to lose that equity. Whereas last time they were underwater on the house, so what difference did it make?
Right.
As the saying went, you could sleep in your car, but you couldn't drive your house to work. So it's a little different this time. But
sorry to interrupt you. The corollary of that is that from COVID, now their house is their work.
Right.
Yeah. Well, that's a great point too.
Yeah.
Another reason that you need that house, and you certainly don't want to be homeless during a pandemic. It's a real nasty scenario. But I want to make sure we don't oversell this. Delinquency rates are the highest they've been in a decade, but they're nowhere near where they were during the GFC. Prices are lower than they were a year ago, but you look at the industrial sector, it's up something like 145% over the last 5 years. So you could also make an argument maybe we overshot value on some of these. To Matthew's point about I'll buy dumb, but somebody dumber than me is coming to buy it back at an inflated price. I've also seen, and this just kind of puts a point on, I've seen foreclosure numbers in the commercial market. They're running 20 to 30% higher than normal, but that means you have 500 foreclosure actions a month. So the raw numbers are not huge. The percentages are very high, and you're actually seeing some fairly significant properties being foreclosed on, which you don't usually see in the commercial market. That's why it's newsy.
And the stuff and listen, there's a ton more that would have been foreclosed on, hence save for what you were suggesting, Rick, where folks handing back keys. And Matthew, about the stories in downtown LA. Everyone knows about Brookfield. I mean, these top premier assets that have where folks are walking away from their debt and making a press release about it. That's a good one. I like that. And the flight to quality, I think that's another interesting point that Matthew Grossman made, which was that's certainly where we're focused is, don't just look at tertiary markets or secondary BC class assets that are being offered on the cheap now, because in theory, if we do go further into the rabbit hole, a la RTC days, there could be commercial real estate in green and growing areas of this country that have zero value, or stuff that's obsolescent, deficient, or whatever. I would say though, it's such an interesting thing, reverse of where we are on. I do agree that on the residential side is the one area that you can be somewhat cautiously optimistic. Not if you're trying to buy a new home. Obviously, my son who's 30 who's trying to buy his starter home in LA, it's a 7-figure start, right? But the lack of inventory. I mean, it's just the market's too big. Not everyone's going to put their house on, even if they lose their job tomorrow, you're not going to see everyone put their house on the market the next day. It's such a big, there's such a long runway that is created by the lack of inventory on the residential side, that's what's going to hold resi a little bit more stable, obviously, while we all get our popcorn out and get excited about commercial. Is that a general?
Yeah, I think you're spot on. The people think this is kind of a hypothetical situation, but it really comes down to math. If you're sitting on a 3.5% mortgage and you sell your house and buy another one at exactly the same price, you've just doubled your monthly payment. Nobody's going to do that unless they absolutely have to. And by the way, nobody sells a house and then buys another house at the same price. So there's a huge financial hit that is causing this rate lock. Almost 70% of homeowners with a mortgage have an interest rate of 4% or lower. They're just not going to move unless they have to. So, if there's divorce, death in the family, income loss, maybe marriage, more kids, you're going to see people move because of that. But, right now, existing home sales are trending at about a rate of 4 million a year. That would be the lowest number we've seen since 2009. But just a little interesting pricing tidbit, Bill. If you look at existing home prices, they're actually up about 2% on a year-over-year basis, which just goes to your supply and demand equation. New homes are median price of a new home is actually off 16% from peak. And it's not because the builders are necessarily discounting, it's because they're now building smaller homes or building homes with a lower cost per square foot to accommodate the higher finance costs.
Right. Or they're buying I think their customers' rates, which in effect is a 10 to 15% discount on price, but the actual price that comes on the title looks the same. That's right. 100%. So there is some obvious edginess going on in residential. I don't want to get too much, but I did want to at least cover on it. And then I do want to turn to one of our questions in the audience, because it somewhat relates in terms of there's hundreds of, and then if you are still here live in the audience and you have any other questions directly for us, we still have 15 minutes left. We will get to them. We have a lot more to cover. In a minute, I want to talk about AI. But one of the questions from our audience is that there are hundreds of non-QM lenders with billions of investors' money begging to give liberal loans, these non-QM hard money loans. Do you see that market? How do you see that market factoring in the near future in terms of opportunities for non-QM lenders?
I think if you're talking about the residential market, credit is tightened over the last year. I think there's an opportunity for QM lenders, but I don't see any of them going overboard with high risk loans. They've tightened up their credit criteria as well, whether it's adjustments to the LTV or looking for a higher debt to income ratio or whatever it is. So is there an opportunity for non-QM lenders to get a higher share in a tight market? Yes. Do I see them getting riskier and making lots of loans, kind of willy-nilly. No,
No.
it's not the right kind of market for that.
And then the commercial version of that conversation is private equity, right, Brian Grossman? I mean, that's really kind of where you hear a lot about these mezz guys coming in and stuff.
Yeah. I mean, look, like we play in that space, and there's absolutely a need for it. But it's challenging, and there's a lot of competition. There's a lot of dollars chasing these deals. And you need to be very careful and very selective. And so much of it also goes back, to Rick's point. I mean, and it also is tied to cost of capital, right? So credit, criteria is much tighter, but the cost of capital has moved so quickly and has gotten so expensive, for all parties and all stakeholders, that there's inherent challenges, presented in the underwrite and the discipline that you're just very carefully sort of playing through.
Yeah.
But yes, there's absolutely a vacuum there for the private lender, the sub debt options. I mean, you've got fractured capital stacks, with quality sponsors, quality operators. The story at the asset level is right and is pure, but it needs some time, so there are gaps there to be filled. And, private lenders will certainly be at the table there.
Also, I think that if you extrapolate out, the challenge you face is that with the non-QM lenders, as you astutely pointed out, Matthew, is, the cost of capital is so high that the reason that these people are looking for alternative funding sources is because they can't afford the rates from qualified mortgages. So they're certainly not going to non-qualified. So the only result is that the pricing has to adjust downward so much that it would make sense for the non-QM, at which point the QMs would step in and say, we'll do that deal. So I think that I'm very well could be not right, but I foresee that a lot of the capital that's in the non-QM space is going to move towards acquiring tranches of delinquent debt and NPLs and looking for opportunistic investments.
Yes, 100%.
I do. I think, Bill, you saw this at the event last week. There is a growing appetite for notes, particularly NPLs, and they've been so scarce over the last few years that I do think there's a huge capital stack waiting on the sideline to swoop in and take advantage of that market. But I had a question for you guys too. We've been talking about commercial as though it's this monolithic enterprise, and I think the various segments are behaving very differently. You look at industrial or hotel or apartment compared to office. Retail has been surprisingly resilient over the last few years. That I think there's a danger in us throwing a blanket over the whole category and saying this is commercial, where the reality is if you're investing in a space and you guys do this for a living, you're probably looking at each sector a little differently.
Absolutely. Certainly, most investment firms and funds are not master of all, right? They have their specialties and things like, for a while, the industrial was the darling investment in the last couple of years. Now it's you're seeing vacancies inch up a little bit. They went from, I think, 3.2 to 4.1 or something like that. And prices starting to soften a little bit on industrial. Maybe it's, that need has been saturated. Multifamily is there's still a gap between buyer and seller expectation in terms of pricing and lending's still quite challenging. And there's a lot of other challenges that on multifamily, such as like insurance is really, expensive now. And in California, it's becoming almost socialist. I own probably 300 million of my portfolio is in multifamily in California. And it's, with the rent control and the government starting to expect the private sector to subsidize the housing for the public, and we're turning into a socialist, government. It's crazy. So
turning into
kept turning, and then when you look at things like malls, they're starting to perform you look statistically, they're starting to perform, certain malls are starting to perform better. They're starting to see an uptick in the sales per square foot, and some leases are starting to renew. But a lot of the retailers are, specifically in California, are saying, look, we're out because there's no, there's too much shrinkage. People were having these smash and grabs. There's no enforcement. The law, nobody's enforcing it. There's these, these gangs of people coming in and stealing from us. And, it's not sustainable. And of course, the cost of that gets passed on to the consumer. So our prices are going up dramatically because of it. And, so we have to have a correction. Politically, we have to have a correction. We have to start enforcing the laws.
And
I'm off my soapbox now.
you see the same in New York City, right? A lot of, I mean, are you seeing the same in New York City, or is it not as bad as it?
It's pretty bad. It's pretty bad. I mean, look, I'm not going to say yet, it's, as deep as some of the issues that we're seeing in San Francisco. But, look, it's moved pretty far, in one direction. And, so look, the rent stabilized. I mean, there's no maneuverability, and your expenses are entirely outpacing, any form of rent growth, the very limited form of rent growth that you're able to realize. I mean, it's degrading the housing stock universally across New York. And look, that's playing through, a multitude of different ways through the city and, the landscape here.
I mean,
so that's very, very challenging.
Yeah, I mean, the perfect example of that in today's day, September 2023, is the FDI's attempt to sell the Signature Bank portfolio. I wanted to actually talk about it here today, but we're running out of time, so we won't be able to jump into it. But there's a segment they just announced this week or last week that there is a segment. They're taking all the rent stabilized loans and segmenting them off, doing a loss shared or seller finance. FDIC is going to hold the majority of the paper, pay fees. I mean,
they're joint venture.
Yeah, they're creating the terms that are basically saying, we think this stuff, if brought to market, would sell for pennies, and we need to make it a lot more tenable and I think, would you agree that sale, which is forthcoming, as well as some big bankruptcies that are on the horizon, might be a bellwether for, how this all starts to go down in the fourth quarter? Anyone?
Most certainly a bellwether for New York.
Mm.
So, and look, I think to your point on the FDIC and the way in which they're staying in on the rent stabilized just speaks to the destruction of value, that really has been realized there. And they're protecting it, for what will be a period of time, but eventually that will synthesize and pass through, the free market.
It's if you look at it from perspective of, it's basically their version of strategic default on their side of it. Is it not?
That's brilliant. I love that.
Yeah, I mean, look, it's a short term bridge.
Right.
But
right.
I'm not sure that bridge leads you anywhere, to a rainbow on the other side.
Yeah.
No, but they're saying, look, we can't afford to walk away from this, instead of saying we can't afford not to walk, and they're trying to serve two masters, trying to wear two hats, and they don't want to realize the losses because it just completely crushes their financials. And they're saying, look, we're doing, we're just gonna strategically default, non-default.
At the end of the day, it's unfortunate, because we are all taxpayers too, and someone's gonna end up paying for all of this loss. And listen, New York City rent stabilized buildings eventually will come back, or there will have to be a change in the law, to reverse what happened in 2019, or who knows. But how far can the government go? Can they go to LA? Can they go to San Francisco? Can we go to the Midwest? I mean, what other sectors, that green and growing markets, how do we become? Well, I don't even want to open this can of worms. Do we?
Well, you're also talking about the difference between, the federal and state laws and the enforcement of, it truly becomes socialist or effectively almost communist if the federal government starts trying to enforce rent stabilization in, there's a push for national rent control, which would be the death knell for investment.
Right.
People would just walk. They'd be like, I'm not doing this.
And at this point, though, they're saying, I mean, effectively what the FDIC is doing in the Signature Bank portfolio is they're saying the taxpayers are going to foot the bill for this mistake, for this change, for this major market devaluation that's going on. I wonder what other sectors they would do that.
Make no mistake about it. The taxpayer is always going to foot the bill, and it's just another form of taxation for the, anytime there's a failure, the bank failure, we're paying for it. It's not being paid for. And all that money that was printed and the massive inflation is still going to end up washing up on our beach. We're going to end up having to pay for it.
Right. I have so many more topics I want to go into, but I want to be cognizant of our audience's time. We didn't even talk about AI. We didn't even talk. Well, we're all gonna have to get back together. Certainly, each of you need to get on with me and do another podcast in the near future. Mandel, you have some amazing stuff that you've been exploring in AI. Just the fact that, like you pointed out to me, that the current chat GPT is the equivalent of a 155 IQ, and the next one to come out, which is 6.0.
So it's 5.0. So it's going to go from, we're right now in 4 chat GPT, it's GPT 4. We're going to move to 5 in the next year, and then 6 in 2 years. Currently, ChatGPT 4 is the equivalent of a genius. It's about a 155 IQ. Thinking Einstein is 162, right? ChatGPT 6, when we get there, will be 3,000 times more intelligent than ChatGPT 4. So what's happening now, and I'll leave you with this to ponder on this, is that currently artificial intelligence is there to assist humans. In the future, humans will be there to assist artificial intelligence.
That's a scary thought. When I saw that note earlier, when you put that on paper, I'm like, I hope you share that. But that's true. That's really what's the shift that's going to happen. And then how that affects real estate, that's a whole nother conversation. The thing that we always end every one of our webinars with is a bold prediction. It could be funny, it could be true, it could be whatever it is. I want to hear each of you comment on what you see, something that will, your prediction for the next 6 months. I'll start with you, Rick Sharga. He gave me the look.
I didn't know I had to come prepared with a bold prediction.
I could give Grossman put him on it. I think he's ready to say.
Yeah, go for it. Go for it.
I'm not nothing particularly bold, but I actually saw that there was a question asked from the audience in regard to adjustable rate. We didn't really touch upon that much here, during our conversation. That is where I am like keenly focused, right? So paper that has been originated in the last 24, 36 months, floating rate, adjustable, in the marketplace today, very, very quality assets that capital structures are terribly exposed and are upside down. There will be tremendous opportunity there.
That's
well, I'll piggyback on Matthew then, because I saw those two questions too. I'm going to keep my bold prediction is the same prediction I've been making since COVID hit, which is that we are not going to see a flood of foreclosures. We're just not. The loan quality was extraordinary. I think Matthew just alluded to that. Equity is at an all-time high. 88% of people in foreclosure today have at least 20% equity in their homes, which gives them the opportunity for a soft landing rather than a foreclosure sale. And candidly, the government is dead set against allowing a lot of foreclosures. So if push came to shove, we'd see more government intervention on this. And Matthew, you and I can debate this over a beer sometime, but I think the the relatively tiny number of adjustable rate mortgages. If you know where to find them, you probably will find some opportunities, but there's just not enough of them to make a material difference in the overall marketplace.
And when
I agree. I agree on that. You know, in the multifamily space, I mean, there's billions and billions of dollars of loans, and you know, there are selective counterparties in banks and originators that those are most prominently and most centrally located with. But yes, it's not a tremendous amount. I mean, look, it's 1.5 trillion, you know, broadly, you know, coming to maturity over the next 3 years. But that's a small subsection of an area of deep focus for us.
and I think
Same thing on the residential side, by the way, the percentages is very small.
well,
Yeah.
that's what I think you're speaking to, Rick. Also, is your prediction is on the large numbers of foreclosures not happening are on the resi side, you know, and there's just not a lot of necessarily actual volumes of numbers on the commercial side, but
Right.
the dollar amounts could be significant in the as Matthew spoke to. So it's less asset, less opportunities, but larger dollar amounts, more on the commercial side. I think that's how you guys are probably in agreement there, right? Yeah. So okay, and then well, Matthew Mandel, let me you could either just any bold prediction or what will be the catalyst for whatever the next, you know, shoe to drop is.
I think that if we have another eruption of COVID and another lockdown, then that could be the in the next 6 months, let's say. I think that could be a catastrophic catalyst.
Wow. I didn't even think of that as even a possibility, by the way. Is that like even like that? Are there people talking about something like that?
COVID
There's a new strain out.
Wow.
There's talk about, you know, so mask mandates are coming back, which then may lead to lockdown again, which would destroy our economy.
Yeah.
Even more.
I think if I had to make
terrible.
bold prediction, it would be that I do believe there'll be discontinuity. There'll be several banks more that will either fail or have to merge before the end of the year. And I do believe that government intervention is the wild card there. So you just spoke to that. I think you've all spoken to it. You know, the areas that are already problematic are the areas where there has been that tension between public good, you know, socialism versus, you know, fundamentals of investing in multifamily real estate or office buildings or whatever. It's been an absolute joy, gentlemen. Thank you for being here, and we've got to get you all back again. For you that were our audience, thanks for attending as always, and we'll see you our next webinar. I know at least one guest, Camille Homsey, will be at our December webinar, and check us out at weekly on my podcast. Thanks for being here, everyone.
Thank you, gentlemen.